Matter of fact, one author said 90% of the mutual funds, the growth stock mutual funds, do not outperform the S&P. Well, that's a lie.
Right, Dave. Since you said it, it must be a lie. And it's wrong. We should just move on, right? If you've ever heard Dave Ramsey talk on investing, he says over and over and over that actively managed mutual funds, the one he recommends, consistently outperform the S&P 500 index funds. In fact, apparently it's 100% of the time since he's come on air, but don't take it from me.
100% of the time since I've been on the air, I have recommended to you, and I have personally invested in good growth stock mutual funds.
Also from Dave, this is from his website. When looking at mutual funds and index funds, Dave says for retirement, mutual funds are the way to go. So is Dave right? Or is this just really bad advice that Dave has been preaching 100% of the time, to use his words, not mine, that active mutual funds are better than the index fund? Well, there's only one way to find out. For those of you who have read my book, you'll know that I'm a big fan of these low-cost, diversified index funds that Dave says aren't worth your time. Before we can dive into that, really quick, let's discuss what a mutual fund is versus an index fund. So the S&P 500, which is the example that Dave gives, is a really great way to talk about this. So the S&P 500 index fund is a fund that follows the S&P 500 or Standard & Poor's 500 index. And this index comprises 500 of the largest publicly traded companies in the US. So you can think about this like the 500 biggest companies, and is widely regarded as primary indicator of the health and performance of our US stock market. Instead of actively managed mutual funds where fund managers make frequent buy and sell decisions, they try to buy the winners and they try to get rid of the losers, index funds follow a passive investment strategy. So what does this mean? This approach involves minimal trading and basically aims to achieve the returns based on those 500 biggest companies. So the S&P 500 biggest companies. So at the time of this recording, you might think about Apple or Microsoft or Tesla, Meta, which owns Facebook, or Alphabet, which is Google, Nvidia, so on. So those are the largest 500 companies. There's a list of 500 that go past the ones that I just mentioned. So in a passive strategy, in an index fund strategy, if company number 499 drops out of the top 500, the fund simply replaces it with whatever company takes its place. It's automatic, it's passive. There's no mutual fund manager picking and choosing. It just follows the index. An actively managed mutual fund, on the other hand, is the kind that Dave Ramsey is recommending. This is where a mutual fund manager's job is to pick the stocks that are going to win and to get rid of the stocks that are going to lose. And they think that they're going to do better than that S&P 500 in this example. So in order to call these funds a success, they've got to consistently outperform the index. Why? Because they are more expensive. And the reason why is because you're paying that mutual fund to do the work of picking the stocks that win and get rid of the stocks that lose and to do the research. And I can't speak for everyone, but I know for me, if I'm paying for something, I want it to do better than the less expensive options. Why pay for a service if it's not worth it, right? You're not going to pay for something if it doesn't do the thing that it says it's going to do. So Dave's take is that these actively managed funds outperform index funds or the S&P 500 in this example. So in Dave's mind, they're worth the cost. Again, don't take it from me. Here's a graph from Dave's site on mutual funds versus index funds. Check this out. So if you look at this graph, you might say, well, hey, look, this proves it. Mutual funds are better than index funds. See, this line is higher than that line. That's why it's okay to pay more for them. They do better. But to use Dave's own words, well, that's a lie. It isn't true. In the clip shown at the beginning of this video, Dave says that someone claiming that the index funds, the S&P 500, outperform actively managed mutual funds about 90% of the time. It's not true. It's a lie. And one of the ways he tries to prove this is by talking about how his own mutual fund investments have outperformed the S&P 500. Listen in.
I own one mutual fund that started in 1973 and has an average annual return since 1973 of 13.43%.
13.43%. That's a really big number, right? I own one mutual fund since 1973. Now, the funny thing is that if you look into Dave's portfolio, I personally can't find anywhere. That doesn't mean it doesn't exist. I just haven't been able to find it in watching videos and combing the site, where he actually mentions the name of the fund that he's trying to use as evidence, anecdotally, for why mutual funds beat out the S&P 500. But using our detective skills, I think we can figure this out. So he does say that it started in 1973, that it has a large cap growth focus, and that it's provided a return of just over 13%. He says 13.43%. Now, if I were a betting man, and I am, I bet Dave Ramsey is alluding to this one, the American Growth Fund, or AGTHX, shown on here by Morningstar as 3 stars. So Morningstar itself doesn't give it 5, it gives it 3. Now, if you ignore all of the fees associated with this American Growth Fund, AGTHX has in fact returned what Dave says it's returned since its inception. But without calling this a bold-faced lie, I'll just say it's misleading at best. Here's why. So what you aren't being told about this fund is that it costs a lot more than an index fund. So while it may have returned that 13.43% since 1973 that Dave is claiming, you then have to deduct things like the front load and the expense ratio, which is what it costs to run that mutual fund and to actively manage it. So we're going to have to deduct the cost of the front load of this fund and the expense ratio. For those of you that aren't aware, a front load is when you give the mutual fund company money and they take some of it right off the top to keep for their own coffers, running the fund. And that front end load for this American fund is a staggering 5.75%. What does this mean? This means that when you invest in AGTHX, this American Growth Fund, 5.75% of your initial investment will be deducted. So for example, if you gave $10,000 to invest in this fund, $575 will be used to cover the front load fee, and that remaining $9,425 will be invested in the fund. So you put $10,000 in, and you only get to keep $9,400 of it to actually do the investing. So said differently, you lost almost 6% of your investment immediately when placed into this fund. Now, I'm not good at public math. I'm not going to do it here. So I asked ChatGPT to figure this out for us. Is the return on this fund really over 13% that some lead us to believe? When we include the fees, you got to pay. Here's the answer. After some fancy math, you're going to see that the return isn't really 13.43%. It's actually just under 12% after you take these fees into account. Now, if you look at just the last 10 years after we take into account all of these fees, while the S&P 500 has returned 11.5%, this American Growth Fund has only returned 11.27%. So even in Dave's anecdotal example, assuming that this is the fund, and betting man, I think it is, what he's saying isn't really true, at least not for the last 10 years. So this anecdotal example that Dave often gives still isn't accurate. The index wins, even in most of his compelling anecdotal examples from his own investments. But again, let's give Dave a break. Maybe his numbers got mixed up. What about the rest of his argument? Because he does give more than just an anecdotal evidence in this video. Is Dave off base, or are those of us who support index funds and say that they win about 90% of the time, are we just a bunch of liars? Let's take a second. Let's make sure we understand Dave's view on things. Maybe he has more evidence than his anecdotal American fund from 1973. In the same video, Dave has this to say.
So somewhere between the last 10 and 40 years, general average is somewhere around a third of the mutual funds, the growth stock mutual funds, have outperformed the S&P.
Is that really true? Are Dave's internal researchers, the one that he pays, are they right? Do large cap growth funds really outperform the S&P 500 a third of the time? Well, they might if you ignore two things: the mutual fund fees we just mentioned and something called survivorship bias. See, there's a major problem in Dave's methodology. We've already talked about how Dave ignores the fees, but there's also something called survivorship bias. When he talks about the 1/3 of funds doing better than the S&P 500, Dave is using only the funds that still exist today and comparing them to the S&P 500. This is called survivorship bias. The ones that still exist must have performed well because otherwise they wouldn't still exist, right? So for example, research done by the ICMA, which is a nonprofit independent financial services corporation, showed that using Morningstar data, 60% of mutual funds that existed in 1997 did not exist in 2014. All of these losing funds that no longer exist are completely excluded from Dave Ramsey's analysis. So when Dave looks at the 80 funds that still exist from when he started investing in 1973, or the hundreds of funds that still exist from 10 or 20 years ago, he is ignoring all of the funds that do not exist anymore. In addition, Dave's also ignoring those fees. So fortunately, we don't have to wonder what the real numbers are. There's something called the S&P Indices versus Active Scorecard, which is better known and more easily said as the SPIVA Scorecard. And this scorecard compares the exact thing we're talking about, the S&P 500 to other large cap mutual funds. And it does so over time. And it's looking almost directly at the argument that we're trying to talk about here. The beautiful thing about SPIVA is that unlike Dave's researchers who get paid by him, it takes into account survivorship bias and those pesky fees associated with investing. So if we look at a single year, Dave's numbers are wrong. But again, let's give him some credit. At least they're close. Around 40% of the actively managed large cap mutual funds outperform the S&P 500. So Dave's wrong here, but he's actually wrong in the direction he'd probably want to be wrong. 40% of the funds outperform the S&P 500 if you look at just a single year. So this is actually more than the 33% that Dave quotes. So we should definitely invest in mutual funds, right? Not only is Dave right, but the numbers are even better than what Dave is telling us. The answer is no. The problem is that you and I aren't investing for 1 year for retirement. We're likely going to invest for 15, 20, or for most of us, 30 years. And when we bring things out even to just 15 years, so we're not looking at 1 year anymore, we're looking at 15 years, that survivorship bias that SPIVA includes and the fees that SPIVA includes that Dave ignores when he does his analysis, when they come into play, the story is quite different. The SPIVA scorecard shows that over a 15-year period, 88% of the time the index funds outperform large cap mutual funds. This is where that 90% of the time index funds like the S&P 500 outperform mutual funds argument comes from. It's really good data. But wait, can't you just pick the 12% of the funds that do beat the S&P 500 index fund? Dave sure thinks so. Listen in.
But if you were to look at the actual track record of the mutual fund and see that for the last 25 years it has outperformed the S&P, or for the last 30 years it's outperformed the S&P, it's a reasonable man's assumption, a reasonable woman's assumption, that that fund might be one of the ones that continues to outperform the S&P.
But is it? Not only is Dave wrong about the percentage of funds that lose out to the S&P 500 over 15 years, he's also wrong that one can reasonably assume to continue to pick the fund that outperforms. Why? Because it's not true. It's an anecdotal example of VGHTX, that American fund. It's outperformed the S&P 500 since 1973. But in the last 10 years, it hasn't. So even in that anecdotal example, it's not true. So can you reasonably expect to be able to pick the funds that will continue to outperform the S&P 500? What are the odds that a fund who beats the S&P 500 in any individual year is continuing to do so over that longer investing period, that 15, 20, 30 years that you're investing for retirement? The answer is that it's infinitesimally small. Even at 5 years, SPIVA research shows that only 2% of all large cap funds remained in the top half of funds just 5 years later. Not 10, not 15, not 30 years. 5 years later, only 2% of all large cap funds remain in the top half. So if 98% of funds can't stay in the top half even 5 years later, what are the odds that they're going to stay in the top half after 15 years? I can't say it's zero, but I bet the odds look more like an asymptote approaching zero. Worse, among top quartile funds within all reported U.S. domestic stock categories as of December 2019, not a single fund remained in the top quartile over the next 4 years. So from 2019 to 2023, not a single fund that was in the top quartile was in the top quartile 4 years later. So the point is this: Dave Ramsey is wrong. To use his own words, well, that's a lie. It isn't true. Unless you ignore survivorship bias, unless you ignore the persistence bias and don't take into account the fact that the chance a fund outperforms the market 1 year and that it will continue to do so is essentially zero, and unless you ignore the fees associated with the actively managed mutual funds. So in other words, recommending mutual funds over passively managed index funds is wrong, unless you ignore all of the evidence. Fortunately for you, you don't have to do the same. So what is my rating of Dave's take on mutual funds? Well, for the accuracy of information, I'll give him a 1 out of 10, which is about the same percentage of time that a mutual fund beats an index fund over a 15-year period. On how many people should choose a mutual fund over an index fund based on the evidence, I'll give it a 2 out of 10 because some people just like to roll the dice to try to be in that 10%. Now, on Dave's commitment to calling index fund proponents liars, even when he doesn't have the facts straight, that's a solid 10 out of 10. He has never strayed from this line of thinking. For 100% of the time since he's come on the air, he's recommended these mutual funds, and I imagine he's never going to change, no matter how strong the evidence actually is. So until next time, my friends, stay calm and index on. See you in the next one.